Well, hello everybody. Welcome to this webinar, which is going to be focused on the topic of eliminating entries for the FAR exam. If you have any difficulty hearing me or seeing me, please just reach out in the chat below and we will get that figured out. But first, I just want to say thank you for attending this webinar. Thanks for taking an hour out of your Saturday morning to learn about this topic. So I'm assuming that everybody here is studying for the FAR exam. And my goal is to teach you one of the most difficult areas of the FAR exam. I think something that confuses everybody with the exam is the eliminating journal entries. It seems really confusing whenever you have a parent company and a subsidiary, and you have this inventory that's going between them, and you have to figure out what the eliminating entry is for it. Also for fixed assets, what happens when the parent company sells fixed assets to the subsidiary, and then you have depreciation to worry about. You have to think about how much did we write up the fixed asset by. So we're going to be addressing topics like this. We're going to go through some examples. We're going to go through some practice questions. So I'm really excited to make this topic a little bit more clear for you. And then after this webinar, I'll send you a recording of it if you want to go back and see anything. So any questions you have during this, feel free to reach out in the chat and I will answer that. I'm Kyle Ashcraft, CPA. My company is Maxwell CPA Review. So what I do is I create CPA courses. I do private CPA tutoring, and this is my passion. So I love doing this. I love explaining these concepts and taking something that's very confusing and has a lot of rules, breaking it down and making it easy for you to memorize to actually pass the exams. So with that introduction, let's jump into eliminating entries. Let me just pull up my Excel here. Okay, I hope everyone can see that okay. We're going to follow this three-step process with these journal entries. So I'm just going to briefly explain it here. So the first step we're going to do is we're going to ignore the cash between the parent and the subsidiary. We're not going to worry about cash. We'll see that a little bit more of why, but the reason is if you have cash that's going from a parent to a subsidiary, well, the parent's balance is decreasing and the subsidiary's balance is increasing. So the net effect is zero. So there's no elimination when it comes to the cash account. So anytime you see a cash account, you can just ignore that. Then we're going to eliminate any balance sheet items or income statement items directly between the companies. And then from there, we're going to adjust any balance sheet or income statement items that we did not have to eliminate, which will make more sense in just a moment. So let's think about this situation. Let me share it this way. Okay. Let's think about a very basic example to kind of conceptualize what's happening. So we have a parent company and we have a subsidiary company. In the practice questions, it usually says some kind of name that starts with a P, right, for the parent, and then some kind of name that starts with an S for the subsidiary. And these two entities are doing transactions with each other. And then you get to the end of the year and you are consolidating the financial statements together. So they're doing these transactions and then you combine those financial statements and you have to do some eliminating entries. The reason is because US GAAP is focused on this principle of conservatism. You don't want to make yourself look any better than you're supposed to make yourself look. So imagine if you didn't have eliminating entries. And let's say a parent company is providing services to a subsidiary. Let's say it's just accounting work, like in this example. So P company does $50 worth of accounting work for S company. Okay, if we think about what their journal entries are going to be, well, P company is going to receive $50 cash, $50 revenue, and then the subsidiary is going to have a $50 expense and $50 of cash that they're paying out. So if we did not eliminate this entry, then revenue is basically $50 overstated and expenses are $50 overstated, because you can't use this entity that you own to inflate your numbers. Investors don't want to see that. The IRS doesn't want you to inflate your numbers. It's not a accurate picture whenever you're inflating your numbers because of intercompany transactions. So that's the entire goal of eliminating entry, is trying to get a more true picture of what's happening with the entity. So in this very basic example, the way that we would eliminate this is, like I said, with cash, we don't do anything. So we can kind of like cross it out. We don't have to do anything with cash. So we can ignore those. And we don't want the revenue here, and we don't want the expense here. So we would just simply debit the revenue for this 50, and we would credit the expense for 50. And that would be our entire entry there, just kind of reversing out. This is a pretty simple example because these are two income statement items. So here's one of the keys with intercompany transactions. You cannot have any kind of revenue or expense that results from the intercompany activity. So if you see any kind of revenue that happens, you're going to have to eliminate that entire amount of revenue. If you see any kind of expense, you're going to eliminate that expense. So this would just be pretty straightforward. You know, debit revenue, credit the expense. So that's how that works so far. Now let me go to a different example. The two main ways that the test makers like to test these intercompany transactions are when you have inventory between both companies, or you have fixed assets between both companies. So let's look at an example of inventory between two companies. So let's consider this situation right here. All right, the parent company has sold inventory to the subsidiary. It originally paid $20 for this inventory, and it's selling it to S company for $30. And then the subsidiary sells 70% of that inventory to a customer. So if you're noticing a trend here, it's that I write out the journal entry for both the parent company and the subsidiary company. This is something that's going to totally save you on these practice questions. Anytime you have eliminating entries, you want to write out the parent's full journal entry and then the subsidiary's full journal entry. So my first question is, what's happening with this parent company? Okay, so they originally paid $20 for this inventory. So when they initially bought it, it would have been credit cash, debit inventory for $20, right? And so then when they sell it, you have to get rid of the inventory, and that's where you expense it for cost of goods sold. Get rid of the inventory, the credit for inventory, and then debit cost of goods sold expense for 20. That part makes sense, I hope. And then they are selling this to the subsidiary, so they have this revenue part of their entry. They're getting paid $30, and then they have the revenue. So then as soon as you see revenue, a red flag should go off in your mind. Like I said, you can't have revenue or expenses that result from the intercompany transaction. So let's take a note of what we're going to have to eliminate here. Cash, we always ignore. And then revenue, we are going to have to reverse out. And we'll come back to the second part of the entry once we look at the subsidiary's entry. So let's think of how the subsidiary is accounting for this. Well, they bought $30 worth of inventory, so they debit inventory for 30, they credit cash for 30, but then they sold 70% of it to a customer. So they're going to write off 70% of what they recorded. So you're taking 70% of what they initially recorded of 30, so they have to write that off, and they expense this 21 here for cost of goods sold. Now, this is before we're considering the eliminating entry. We're just trying to understand what's happening before we focus on this eliminating entry. Let's think about what's happening here. This inventory initially cost 20, but then it was artificially inflated up to 30 because of the intercompany transaction, and that should not have happened. We need to eliminate that difference. So here's a key question I'm going to repeat several times today to wrap your mind around this. We need to ask, what would the entries have been if instead of this inventory going from parent to subsidiary and then subsidiary to the customer, what would it have been if it went straight from the parent to the customer? So if we never had that middle transaction to the subsidiary, how different would this entry be? So if it went straight from the parent to the customer, well, we would not have done $21 of cost of goods sold. Because imagine that this 70% was sold to the customer directly from the parent. So they had $20 of inventory, and they would have sold 70% of that. And so you would have had $14 of cost of goods sold instead of this 21 that they have recorded here. So we're asking ourselves, what should it have been, and what is it recorded for? And the difference between that is what we are doing for our eliminating entry. So we have to ask this question right down here. We have to ask, what is our cost of goods sold recorded for, and what should it be recorded for? So it is recorded for 21, as we see up here, but it should have been recorded for 14, because that would have been 70% of this inventory from the parent's perspective. So we ask, what is it compared to what should it be? And the difference, as we see, is this $7 decrease to cost of goods sold. So we know that we're going to have to decrease the cost of goods sold by this 7. Let me expand this screen sharing so we can see all of this at once. All right. What I'm doing over here is writing out the full adjusting entry. So we're going to have to decrease cost of goods sold by 7. And then also, this expense right here is a direct result of the intercompany transaction. So in other words, this entire $20 needs to be eliminated, just like this entire $30 of revenue needs to be eliminated. But this entire $21 of cost of goods sold does not need to be eliminated, because the entire $21 wasn't a related party intercompany transaction, because we actually sold it to a customer. We just recorded it for too high of a dollar amount. So in other words, we are decreasing cost of goods sold by the 20 here, and we're doing the $7 adjustment because we shouldn't have done this for 21. It should have been for 14. That's why over here, cost of goods sold is going to be 27. We are we are crediting it because it was initially debited. And we always just make sure that everything balances here. And this is our full eliminating journal entry. I hope it's not super confusing, but I think it takes a lot of repetition to start really making sense. What I'm going to do here is color code where these changes are coming from. So that's that revenue there. I said cash we just ignore. So I'm just going to make that red. We ignore it. This inventory we don't do anything to because it actually did leave the parent's books. So it's not like we have to reverse out that inventory. So we don't do anything there. This cost of goods sold, we have to eliminate that entire amount. So that's going to go into this part here. Now we get to their inventory balance. So at year end, the subsidiary is going to have an ending inventory of $9. We need to ask, what should it be if they sold this inventory straight to the customer? So should it be 9? No, it should be a lower amount. Because once again, if they sold 70% of this $20 of inventory to this outside party, then the only remaining part would be 30%. So it'd be 6 for the ending inventory. So we ask, what is it and what should it be? So it's currently 9 because of these two. What should it be? It should be 6. Therefore, we need to decrease it by $3. So we are looking at both of these, which leads us to this $3 adjustment here. And then we said instead of 21, this was supposed to be 14. And so that's going into our cost of goods sold adjustment right here. And that's our full eliminating entry from this inventory between the two entities. So now I'm going to stop sharing my screen for a moment and just see what questions we have. All right, thanks for your question, Trisha. Jump over here. There we go. Would the exam pose the question directly from parent to customer or this direct way parent to? If you're talking about inventory, there's always going to be the customer involved. So with inventory, it's going to do parent to sub to customer. Sometimes it's going to say that they sold 100% of the inventory to the customer. What that means is that when we're looking at how much we adjust the inventory balances by, we need to make sure that the ending balance of inventory is 0 because we sold all of it. But in our example, they sold 70% of it. So we just have to be careful for how much they actually sold between the entities. That is a great question. All right, now I'm going to jump back into it and look at a fixed asset example. With fixed assets, there's no outside customer to worry about. They don't usually say the parent sold it to the subsidiary sold it to the customer. That doesn't happen. It's just parent to subsidiary. So let's take a look at this here. Okay. Parent sold fixed assets to the subsidiary. Fixed assets originally cost $20 and had a carrying value of $10, meaning that accumulated depreciation was $10. The fixed assets were sold for $25. Asset was originally bought 4 years ago and was estimated to last 8 years. They used the straight line method. When subsidiary buys the fixed assets, it estimates 5 remaining years of useful life. So the first step with any kind of eliminating entry is write out the journal entries for both entities. So let's think about the parent company and what's happening here. So they sell a fixed asset that was on their books for $20. So they have to get it off of their books. They had $10 of accumulated depreciation, so they need to debit that off of their books. They are paid $25 from the subsidiary. And as we know, a gain is the difference between what you're paid and the carrying value. So you're paid 25, carrying value was 10, so your gain is 15. So this is their entry before looking at the eliminating part of it. On the subsidiaries side of things, we are debiting the fixed asset for how much we paid for it. So we see that it was recorded for 20, but now it's recorded for 25. We paid the 25 of cash, so we would be crediting it. And then we've owned it for a year. Let me just add this, that this transaction occurs on January 1. So this happens at the beginning of the year, so we're going to have 1/5 of depreciation expense because we estimate 5 years of remaining life. They thought that it only had 4 years left of remaining life, and now we have 5 years left. Once we get all of the facts organized, then we can start to eliminate this. So the question here is not, what would it be like if it went straight from the parent to the customer? It's not like that with inventory. The question is just, what should this be recorded for if this intercompany transaction never happened? We're trying to reverse out all of the effects of this transaction because we can't just inflate a fixed asset. I mean, imagine that they paid like $1,000 for it. That doesn't mean you can suddenly change it from being $20 to being $1,000. So we need to reverse out all of the effects of it. The first easy one is cash because we do nothing to it. Let's look at fixed assets here. So it was $20 on our books, and then it was written up to 25. We're not allowed to do that, so we're going to have to go ahead and decrease it by that $5 that it was inflated by. So this leads us to our eliminating entry of a credit of $5. We'll get to accumulated depreciation at the end. We have a gain. A gain is like a revenue, and just like with the inventory, we cancel out the entire revenue. We're going to cancel out this entire gain here. You're not allowed to have a gain between the two companies. So we're going to debit that out to get rid of it. Now we're left with depreciation expense and accumulated depreciation. So we're trying to ask the question of what would this be if this transaction never took place? Well, imagine that P company still owned this asset. They were doing straight line over 8 years. So they would have simply done 1/8 of the asset. That would have been their depreciation expense for the year, right? And their accumulated depreciation would have been the $10 that it was at the beginning of the year plus the extra $2.50. So their accumulated depreciation would have been $12.50. But what it's recorded for is $5. So it should be $12.50, but it's recorded for $5. So it's that question we're constantly asking, what is it versus what should it be? So we're going to need to increase our accumulated depreciation by 7.5, which is where we see that on the eliminating entry. So I'm going to highlight this, this, and this. This leads us to our $7.50 adjustment. And the last part is depreciation expense. So what is it? What should it be? What is it? It's $5. It's recorded for $5. And that's because they bought it at 25 and they thought it had 5 years left, so they did 1/5. But it should be recorded for $2.50 instead. So we're going to have to credit out this $2.50. So we need to get rid of that there. And that's the entire process for the fixed assets. So we're reversing out the impact of the write-up of the fixed assets. We're ignoring cash, as always. We're getting rid of any direct revenues that take place. And then we are adjusting the accumulated depreciation to its correct balance. And then we are getting the depreciation expense to be the correct amount. Just like we were adjusting the cost of goods sold for the inventory, here we're adjusting the depreciation expense. And that is your eliminating entry for the fixed assets. So does anybody have any questions about that? Oh, you could. Oh goodness, you couldn't see the board. So sorry about that. Let me show you what I was doing then. Here we go. It's going to make a little bit more sense now to be able to see it. Okay. So let me talk through this journal entry again, now that you can actually see it. So we were initially recording the fixed asset for 20, but then we wrote it up to 25 here. So since we wrote it up by $5, we're going to have to decrease it by $5. So that's where this credit to the fixed assets comes into play. The cash we do nothing with. The accumulated depreciation, we wrote off 10, so we brought it to 0, and the subsidiary recorded it for 5. So they have it recorded for 5, but what it should be recorded for is $12.50. So basically, if P Company still owned it, then it would have been $12.50. So we're trying to do this adjustment between what it is here of the 5 and what it should be recorded for of the $12.50. So then we get this adjustment here of a credit for $7.50 to look at the difference here. Then we have the gain that we need to fully eliminate. So we have a debit here of 15. And then we have the depreciation expense. So the subsidiary recorded $5 of depreciation expense, but if this transaction never happened, then it would have been $2.50 of the depreciation expense. So we need to adjust it to bring it from $5 down to $2.50. So we're doing this adjustment here. I'm going to give you just a moment to kind of read over this because I know you couldn't see this whenever I was initially talking through it. So let me do this. Let me kind of turn off my video here and then share this here. All right, and I'll just keep it here just for a moment for you to look over. Okay, now that you've had a minute to look over it, then are there any questions about that fixed asset. So anything that doesn't make sense there, or that you want to get a little bit of clarity on. So any questions? I'll just give it just a moment if you want to write out any questions. All right. Now what we're going to do is we are going to go through a full practice question. So far I was just kind of making up the numbers and trying to explain the theory of it. Let's go through an actual CPA practice question and just apply the same exact approach to one question that is for inventory and then one question that is for fixed assets. And this time, let me make sure that I actually share the screen. Okay. All right. I think I'm sharing it now. Great. Let's look at this question here. All right. On January 1, year 1, Peterson, the parent, sold equipment to Silver for $120,000. The equipment was originally purchased on January 1st, year 1 for $100,000. This is a fixed asset transaction. We're going to try to reverse out this entry that happened. Peterson was depreciating the equipment over 10 years using straight line depreciation, no salvage value. Silver decides to depreciate the equipment over 8 years, also using straight line depreciation. Assume all other appropriate entries were made. First step in all these questions is writing out both of their journal entries, right? So we look down here. So the subsidiary is buying this fixed asset for $120,000, and they're paying the cash of $120,000. Then they are going to be depreciating this asset because they own it now, and they're going to do it over 8 years. So they have this depreciation of $15,000, 1/8 of $120,000, and here's the accumulated depreciation. From the parent's perspective, Peterson, they received cash of $120,000. They got rid of the fixed asset off their books by crediting it for $100,000. They had $20,000 of accumulated depreciation, and then they had a gain of $40,000, just the plug number. So we've written out both of our journal entries, and now let's eliminate the entry. First thing, cash we ignore, right? We look at his fixed asset. It was originally $100,000, and then it was written up to $120,000. So it shouldn't have been inflated by this $20,000. So we need to reverse that out. So we're going to see this entry right over here. We are crediting the equipment for $20,000 because we recorded $20,000 too much. I'm calling it fixed asset, equipment, just the same thing. Okay. What happens to the gain? It gets entirely deleted. So we just need to debit out this gain of 40,000. Easy enough. Then we have to look at the accumulated depreciation and the depreciation expense. So the question is, what would it have been if this transaction never happened? Well, if P still owned it, then they would have had, let's see, they would have had, okay, so 2 years have passed. They owned it for 2 years and they're just doing 10,000 a year. So their accumulated depreciation would have been just 10,000 times 3, because they would have had it for 3 years, right? And their depreciation expense for the year would have been just 10,000. And then what is it under subsidiaries books now? Well, it said they were doing it over 8 years, so they just had this 15,000. So in terms of depreciation expense, it needs to be 5,000 more than we actually recorded it for here. So we need to debit it for 5,000. We need to, let's see here. Okay, it was over-recorded. It was over-recorded, so it was 15,000. It should be 10,000. So we need to credit it for this 5,000 here. And then what would accumulated depreciation have been if this transaction never took place? Well, it would have been 30,000, but the way it is right now, it's 15,000. So we need to increase it. We need to credit it to get it up to this 15,000. And that is our entry. Once again, we always make sure it balances. Great. It's such a good feeling at the very end whenever everything balances and it works. That would be our eliminating entry there. So I'm going to stop sharing just for a sec to see any questions or anything. No? Okay. So we're going to go through a practice question for the inventory. And then any other questions that you have, I can answer at the end. Yeah, sure, Tricia. Let me put up the entire question. There we go. Okay, I'll just let you take a look at this for a moment. For me, I love this approach just because it helps us to kind of break this out step by step, you know? All right, let's look at situation number 2. Okay. Throughout year 3, Peterson sold merchandise costing $30,000 to Silver at a price of $50,000. Silver sold 60% of inventory by December 31st, year 3. Silver remitted the payment. That doesn't really matter. So we have inventory, and then they sold 60% of the inventory to a customer. So we're going to be asking, what would the entries have been if it was sold directly to the customer instead of going to the subsidiary first? So we write out Peterson's entry. So they sold merchandise, so they're having to get it off of their books here. by debiting the cost of goods sold for $30,000 and crediting the inventory for $30,000. They also would have revenue from the sale of $50,000, which we know we're going to have to reverse out the entire amount, right? And then we go over to silver. They buy $50,000 of inventory, so we have to debit that, credit cash. And then they sell 60% of it, so they would be recording cost of goods sold for this 60% of 50,000. So that's how they're recording it there. Any questions or anything about these entries before we eliminate them? I imagine it's pretty straightforward, no? So we have to adjust things now. Cash we ignore. Any kind of revenue or expense directly between parent and subsidiary we have to get rid of. So we notice over here we're going to debit revenue for $50,000 to get rid of it. And then we wrote off all of our inventory because we sold all of it to the subsidiary. Just like we got rid of all of the revenue here, we get rid of the entire amount of the cost of goods sold. So our cost of goods sold is going to be $30,000 adjustment plus whatever additional adjustment we have. So it's going to be $30,000 plus something. So the question is, what is cost of goods recorded for and what should it be recorded for? 30,000 is what we have here, the 60% of it. So we have 30,000, but it shouldn't be 60% of 50,000. It should be 60% of 30,000 of what it was initially recorded for, going from the parent straight to the customer. So we see that cost of goods sold should be 60% of 30,000 instead of this 30,000 here. So then what should it be? Cost of goods sold is recorded for 30,000. So the adjustment is the difference. We need to decrease it by 12,000. So we need to decrease it by 12,000 here and then by 30,000 here. So we're going to have a total cost of goods sold adjustment of 42,000. I feel like the cost of goods sold is the most confusing part of this. But once you practice it a little bit, it starts to make sense. So that focuses on our cost of goods sold. And then we have the inventory. So this 30,000 we don't do anything to because it actually did leave the parent's books. For the subsidiary, they have a current balance of 20,000, you know, the 50,000 initial inventory, and then they wrote off 30,000 of it, so they have 20,000. So it's currently recorded at 20,000, and then what should it be recorded at? It should be recorded at, well, if they sold 60%, they should have 40% remaining in inventory. So they should have 40% of this initial amount remaining in inventory. So it should be 12,000. So it is 20,000. It should be 12,000. We need to decrease it by 8,000. So that's where we get this credit of 8,000. And that is our full eliminating entry. I'll just leave this up here for you to take a look at for a moment and ask any questions that you might have with it. But just going back to our initial 3-step approach, we ignore the cash. We're going to eliminate the any kind of revenues or expenses directly between the entities, which is what we did here and what we did here. And then for the items that we don't eliminate, but we adjust, we have to see what they should be and what they are. So we adjust the remaining accounts. So that is how eliminating entries work. A few of the eliminating entry topics we don't have time to get into are for, like, when you have dividends between the two entities. But with dividends, you just eliminate the entire amount of dividends because you can't have a dividend from a company that, like, you're the owner of the company and they're also in your equity section. So it's kind of like you own yourself. So you can't record the dividends to yourself. So dividends get fully removed. And sometimes you get asked about, like, bonds payable for eliminating entries. The question to ask would be, what would happen with this bond if, instead of it being a transaction between the parent and sub, if it was still with an outside party? So you'd have to do a little bit of adjusting for that. But inventory and fixed assets are the areas that this shows up in the most. And that's how it works. I hope that it's become a little bit more clear for you through this explanation. I know for me, when I was studying for the exams, it was a very frustrating area because I felt like I just couldn't wrap my mind around it. It was just too vague. I couldn't figure out what the main purpose was with it. So hopefully having these steps start to help it make sense as well. Now, anytime you learn something, you need to actually apply it yourself. So what I would encourage you to do after this webinar is go to some practice questions and try it out. See if you can apply the same exact approach. And if you run into any issues with it, you can feel free to email me. I'm going to send everyone attending an email after this, but I'll just give my email here, kyle@maxwellcpareview.com. I would love to answer any questions for you. And if you are looking for any kind of private tutoring, I love doing it. My approach for tutoring is very similar to how I was teaching this topic today. I use Excel, go through examples, go through the theory of it, apply the theory to practice questions. So I've done, I think, over 300 hours of tutoring sessions, and I've done it across all 4 exams, so I feel pretty comfortable with all the topics. So feel free to reach out if you're interested in that at all. But apart from that, any other last questions or anything before we wrap up today? I'll just leave it here for a minute if anybody has any questions. Good question. Do I have a review section for FAR? I unfortunately do not yet. So BEC is the first course that I created, and the course I'm working on right now is actually the audit exam. So I'm trying to complete the audit exam right now. So it's going to have to be after I create this audit exam. So unfortunately, I do not. I wish I did. I have some FAR content just out on YouTube. For example, if you're practicing the leases between operating leases and finance leases, I got a video on that explains it with all the journal entries. That can be pretty helpful. So in the future I will. So I really wish I did, but I just need a little bit more time to put it all together. Great question. So with that, we'll go ahead and wrap up this webinar. Feel free to reach out with any questions you have, and I hope that this hour has been beneficial. For upcoming webinars, next Saturday at 12 p.m., I'm going to do another webinar. I will email you that info, but it's going to be my website /webinar, and that's where I'll keep the updated webinar links for it. So I just got to figure out which topic. I'm going to try to choose another difficult topic to talk through. So I would love if anybody came to that next week. And with that, thank you very much, and hope to see you all in the future. Hope you have a great day, and good luck with your studying. See ya.